Hi everyone, and welcome to this week's episode of Gretchen and Pam on Property, where we engage you on all things property and where you can engage us on all things property. Welcome. My name is Gretchen and I'm from the Bedford View branch, and this is my friend and trusted colleague Pamela, and she's from the STBB Lover branch.
Hello guys.
So today we're going to be talking to you about bonds and what you as a buyer qualifying for a bond should look out for in your mortgage loan agreement. We thought we'd also add in a few tips on how you could save yourself an extra couple of bucks. So when you look at your mortgage loan agreement, you would first look at the first two pages, obviously, but they are so important, Pamela. Why would you say so?
So I mean, you get the gist of like the numbers that are very important in there. You know, the conditions, and you get to understand how much you'll be spending, how much you've been offered, what you need to pay, what you will be paying, the term of the bond. It's just very nicely put together in those first two pages that you're just like, okay. And then the rest will obviously elaborate the terms and conditions. So one of the things that I would say, since we already mentioned that we want our clients to, save the money where we can, and one of them is the initiation fee. You'll find that there's a loan amount that the bank has already, or the financial institution has offered you, and then there is a initiation fee. Now that initiation fee is obviously stated that they give you two options of how you can pay it. It's either you pay it up front or you pay it over the period of the bond. Now what we advise as money savers is that you focus on you rather opt for paying it upfront, because then there won't be any interest that accrues over the period of the bond.
Yes, and
right.
on that fee. So yeah, that's
so you've saved money. You've saved money just like that, and that's a hefty sum.
Absolutely.
Yeah.
And I mean, one of the other things you'll find on there is also your interest rate. So the interest rate, I think our viewers must just take note, is variable. So as and when the interest rate or prime interest rate changes with the Reserve Bank, that is going to have an effect on your interest at the end of the day as well. So it could mean that it goes up, but it can also go down. So whilst it's favorable, rather take advantage of it, pay extra off on your bond if you can, so that should it go up, then you are ahead and it won't affect you as badly.
And I think, Gretchen, that's such great advice, because at the moment where we stand, the base is standing at 7, and it could be favorable to you, and you find that so affordable, but it can go up, and that obviously will impact your installment. And that's one thing that I also suggest to my clients, that look at what you can afford. Think about, the eventuality of it going up or down. Take those things into cognizance. So for instance, we have such a great tool at STBB called the STBB Direct app. It is wonders. I mean, you can go on there. There's a calculator where you can punch in your whatever amount that you're going to apply for, the bond amount that you've received or you are going to apply for, and that app will basically calculate for you how much you will be paying. And you can obviously then look at your finances. You know what I mean? And it assists you to just play a good visual of where you're going or what might happen, and how will you be in affording that, or will you be able to?
So just to interject there, Pamela, so basically it calculates your bond registration costs, but you can also calculate what your installment will be with a particular interest rate over a certain period of time. So it's just so useful on so many levels.
I love it.
I
absolutely
sure.
love it.
And just continuing on your mortgage loan agreement, I always say one of the most important things for you to know is that you need to maintain your installments.
You need to maintain your installments. If it's very important that you know that should you get into a position where you default, communicate with the bank. They always, financial institutions are always there to assist, so that you can restructure and make sure that your bond continues, and you can basically just continue paying, but make the communication instant.
Agreed. So, and also I'd say one of the second most important things for our viewers to realize out there is obviously you're taking out the bond maybe for 20, 25, 30 years. And a lot can happen in that period of time. Let's say after 5 years, you decide to sell this property. Then that mortgage loan agreement reads that you need to give the bank 3 months prior notice of your intention to cancel that bond early. So I always, by way of a practical example, like to illustrate and say, by the time that you phone the agent to market your property, then you phone the bank to give them notice that you are cancelling your bond. Because obviously if you sell, per implication, you're going to cancel, because you can't have a bond over a property you're no longer going to own. And if you fail to do this, you as a then seller could be liable for 3 months worth of penalty interest, up until 3 months worth of penalty interest. Yeah. And none of us want to be out of pocket unnecessarily. So
So, today we just basically wanted to touch base on just just the few things that we know about mortgage loan agreement and what we see in practice and what our clients ask us and what potential clients ask us. But we know that obviously there's more that you may ask, there's more that you may think, and we say engage with Gretchen and I, engage with the platform that we've given you, send us emails, call us. Our respective branches, we're available to engage you, to assist you, to hold your hand through any property journey that you're walking into. We are your property friends.
Thank you so much for watching, and until next time, have a fantastic day further. Bye.
Bye, guys.